Interest rates are going up and so too will mortgage rates. In this video, we are going to be covering what some top industry experts predict for the Bank of Canada rate and how that will affect the mortgage rate in turn. Stay tuned to the end. We'll be discussing what one top analyst at TD has to say about how the raising mortgage rates will affect the housing market. But if this is your first time here, my name's Nick. Welcome to Waste of Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. We've discussed it many a time on this channel before. Interest rates are definitely going up in the year 2022. And we're going to focus this video particularly on the mortgage rate. There's an old adage that obviously as the money becomes more expensive, maybe this will help cool off our housing market. So like I said at the beginning, stay tuned. What one analyst has to say about that. We are going to start with the article that I found on CTV saying expect mortgage rates to rise in 2022. And they pull out some information, first and foremost, from a Queen's University economist by the name of Don Drummond. And he expects that the rate will definitely be going up. He's pegged it to go up by 0.75% by the end of 2022. That would make it 1%. Right now, it's sitting at 0.25%. So that's the Bank of Canada overnight lending rate, the rate in which they lend to other big six banks. The other big six banks then add their profit margin on top of it and then provide us with the mortgage rate, for example. So if if it's going to go up for these banks by 0.75%, it's definitely going to go up for us by that amount, if not more. We'll be discussing a little bit later about where that could potentially go. But he sees that the rate will be anywhere between 1.75 and 3% by the end of 2023. We also have Robert Hogue, a senior economist at RBC. He predicts an increase closer to 0.5 percentage points in the central bank's interest rate by the end of the year. They're going up regardless. So those are two top economists, and they definitely think the rates are going up. This article is from October. We're getting a little bit more data coming out of the big six banks. So BMO, CIBC, National Bank, RBC, Scotiabank, TD Bank, you know them all. Their target for next year is definitely over that percent mark. So we had the economist there at 1%, and then the other one from RBC, we had him coming in at 0.75%. Where all the banks here are targeting a percent or more. National Bank has it all the way up to 1.5% here. And as we continue to roll through the year's target of 2023, we see that these rates are continuing to go higher. So obviously the correlation again is that if this overnight rate goes up, so too do the mortgage rate. So it's definitely well known across the board that inflation and other factors are causing the central bank to have to increase. There's some other economical reasons as to why we need to start raising them, but there's a lot of people out there that actually think that we won't be able to get higher than this number without the economy failing, but that's neither here nor there. What we'll discuss right now is what happens if the mortgage rate goes higher on a general basis. So higher rates shrink home buying budgets in tight markets as pushes down prices. So this is kind of that general connotation that we talked about before, that higher mortgage rates will actually push housing prices down further. And this just gives you a general idea of how much 1% increase in the mortgage rate does in terms of a $2,500 mortgage payment. So this assumes a lot of things. It's just to give you an understanding as to what's happening. So rates are probably sitting around the 2 to 3% mark today, which gives you an option of either $590,000 or $530,000 worth of mortgage. And as that rate increases a percent, your purchasing power or the mortgage size capability drops by 60 or 55,000, which is definitely a lot of money. I know right now in the housing market, bidding wars are shooting housing prices up by this, if not more. But on a realistic market, this just gives you an example of how this rising interest rate will eventually cool down prices over the long run. We're going to scroll up here, and what this website has done is it's collected a data, and they've looked at what the average mortgage rates are, looking at both variable and fixed. So on the max side for a variable, we're seeing about 2.5. Variable is normally the one that is less. It just means that you're not locked in, and if the interest rate does rise, and this number will too rise in comparison. And then we see on the fixed side, locking in at a max of 3%. You could even lock as low as 2.1%. There's a lot of other factors that are based in this. The 5-year is very similar as well. So with the interest rates rising to potentially, on the Bank of Canada rate to 1%, what could this do for mortgage rates? Now, this website, if we scroll down, it has basically a forecast of what it expects all the way to 2023. And as we sit at Q1 of 2022, it basically predicts around a 2.82%. And then as we move throughout the year, it gets as high as 3.5% at the end of Q4 in 2023. So we're definitely seeing the mortgage rates could go from 1 to 2% realistically, based on this 2.82 all the way up to probably about 3.3% in Q4. So that's on the fixed. We'll be looking at the variable very shortly, but you're not looking at too much of an increase there, probably 0.5%, if that. We also have the variable here, and this is something that's going to move more rapidly at the end of Q4. Basically where we're sitting today is 1.6%. We're going to see that carry over to next year. And then what we're going to see at the end of Q4, we're going to see probably a 2.4%. So this is where you're going to get a little bit more of an increase. But if you look at that on a realistic basis, yes, the overnight rate from the Bank of Canada has gone from 0.25 all the way up to 1% potentially this year, which is a massive increase, probably 4 times, 400%. We're not really seeing that on the interest rate level. And that kind of gets me into this next part where we talk about this TD analyst. And this TD's analyst name is Rishi Sondhi. My apologies if I misstate that. But what this article has come out and said, at the end, we're going to scroll down to the bottom line. We're going to explain it a little bit. But the bottom line is that higher interest rates are likely on the way, and our forecasts simply imply that they will exert a moderate drag on housing demand. However, a supportive macro backdrop alongside stress tests that offer ample room for rates to rise before buyers are crowded out should keep activity holding above pre-pandemic levels next year. Affordability has become much tougher due to the rapid escalation of prices during the pandemic. That said, Canada has in its past managed to weather a situation where the cost of living was even worse without seeing a severe re-entrenchment in activity, and both new and resale markets remain drum tight, suggesting another strong year for price growth is in the cards for 2022. So basically, that in a nutshell, to my understanding, is the fact that the interest rates, yes, the mortgage rates are going up, but it's such a minimal impact. It won't really have too much of an impact of what the mortgage payment will be. If anything, over the long run, the home buyer will pay more in interest, but it won't be seen on a month-to-month basis. There's also talks about demand here. There's not enough supply in the marketplace, with the fact that people are still passing the stress test at levels today, with supply being so tight. it's really going to be status quo heading into 2022. So I know there's a lot of understanding where people think that higher mortgage rates will push housing prices down. That is definitely the correlation of the past. It will definitely not be seen in this short term. It won't be seen in this year coming. So definitely not what the best news, the bearer of bad news today. But yeah, no, it definitely makes sense what they're saying here. I mean, what do you think? Do you think mortgage rates are going to be higher than that 2.8 to 3.3% that we looked at before? Do you think we see inflation running a little bit more rampant where this could potentially go higher in years to come? Let me know your thoughts down below. If you're still here with me, hit that like button. I definitely appreciate that. I hope you all have a great week in the markets. Happy trading.